Good afternoon, everyone. Welcome to the inaugural episode of the Structurally Speaking podcast series. At Hildene, we're excited to use this new platform to discuss investment opportunities and current trends in the industry in a more laid-back and friendlier way. Today, I'm joined by my boss and good friend, Brett Jefferson, the founder of Hildene Capital. We'll be talking about non-QM mortgages, a large and attractive asset class in the structured space. We'll also speak about what gives Hildene a competitive advantage in this product. Welcome, Brett. Let's start with a little background. Can you tell us what sets Hildene apart?
Jason, thanks for taking time out of your busy day. We're really excited about this new platform. We hope it's going to educate, people in the market and just let people know who Hildene really is. But who is Hildene? We are a structured credit asset manager. What is structured credit? We invest or create things like CLOs, mortgage-backed securities, trust preferred, CDOs, consumer receivables. And when you think about structured credit, what you really should be thinking about is a CDO or a CLO is in essence a standalone finance company. Whereas in a CLO, the underlying assets are corporate leverage loans, broadly syndicated leverage loans. It's governed by an indenture, so it's self-governed. And you're issuing debt to create a good return, just as a bank or any finance company would do. So we're either buying, creating, breaking, nurturing all of these different structured products assets. And unlike, when I think about how we have been labeled because of our involvement with trust preferred CDOs, many people think that we are expert in trust preferreds, and we are experts in trust preferred CDOs. But my background is not an expert in banks. And when you think about how you look at a CDO or any structured product, you're looking at three things: the value of the assets, the value of the structure, the value of the option. The value of the option is how can you break or how can this deal be retired early? Very important. And you take those three components and you figure out, am I being compensated well enough for the risk that I'm taking? Now, unlike an equity manager who can say, I'm an expert in technology or I'm an expert in retail stocks, we understand the underlying credits, but by no means are we on saying we go in and break down every single underlying credit. There's just not enough time in the day. What we do is we have a system where we go through and we break down the assets, understanding the risk that it takes and the risk associated with these structures. And then we make an assessment is, are we being compensated well for this risk? Everything we do at Hildene, though, we do it because we have a competitive advantage. And that competitive advantage can fall under three different ways. It can be information, it can be knowledge, or it can be sourcing.
Although we could talk about structured credit for a long time, real question, and for this topic, for this podcast, I really want to understand, what is Hildene doing in the mortgage space? A topic that has really come to the forefront recently. There's, especially with the election coming up, you hear a lot of stuff about housing and what's going to happen with interest rates. What are we doing in that space?
Sure. So what we're doing in housing is really a few different types of, we'll call it products. Like everything else I spoke about before, we don't do things unless we have a competitive advantage. And the competitive advantage here in many ways is sourcing and understanding, creating a system to basically streamline a process. And we're really involved with a few different products. One product that we're involved with are non-QM mortgages. At Hildene, we have a strategic relationship with CrossCountry Mortgage. CrossCountry is the number one retail lender in the country, bank or non-bank. We have purchased over $3.7 billion of loan to date with CrossCountry Mortgage. The next product that we're involved with is affordable multifamily. This is a small group which works with Freddie Mac with the small balance multifamily B pieces. To date, Hildene accounts have purchased 11 deals representing $240 million of market value. To think about what this is, Freddie Mac issues at a 70 loan to value. They then sell off the bottom 10% or the 63 to 70. That is what we purchase. It is a very competitive group to be a part of, and we're very fortunate to be one of 3 other people who are in this group. The next thing we're doing are HELOCs and second liens. We have a relationship with Figure Technologies, a HELOC originator and sponsor of securitizations, and we have an equity interest in Button Finance and an ability to purchase all of their originated assets. We also are doing things with cross-country mortgage on the HELOC and second lien space.
So that's a lot of different products, and I'd love to delve with you on all of them. But for today's podcast, I would really like to focus on just one: non-QM mortgages. Can you explain what those are?
So I think the first thing that we need to talk about, Jason, is what was subprime. Okay, subprime mortgages, back in the golden age of deregulation, were very low FICO scores. So your non-QM mortgages usually have a FICO score of 740, and as opposed to a low 600 FICO score for subprime. I think the real driving factor is 2 things. One is the amount of money down that goes into a subprime. Your average subprime mortgage had between 0 and 5% money invested in the house. Okay, so the ability to walk away was very easy. The financial commitment was very, very low. The non-QM mortgages that we're purchasing today have 30+% down. So for a $1 million home, there's $300,000 down. And they're larger balances than the subprime mortgages were also. The other important fact is these are structured to the worst case scenario, the non-QM, whereas subprime mortgages had teaser rates where for 2 years it was very low interest and then the payments would escalate, forcing people to basically walk away from their homes. And when you have no money invested in your home, it's very easy to just walk away.
So are you saying non-QM mortgages are for low-income houses? Or in terms of this, you're saying there's a higher FICO score, but are these a very similar type of housing owner to the subprime crisis, or is it different?
Very different, very different. So your non-QM buyers really fall into 4 categories, we would say. The first one would be someone who is self-employed, their income is verified, unlike subprime, which there was no verification. But think of it as a doctor or a lawyer who's self-employed. This is a good example of what the requirements are. So a 740 FICO, loan to value of 70%, meaning 30% down, and debt to income ratio of 30%. So that's one type of person who would be buying a non-QM mortgage. Fannie doesn't allow those people to buy because they want people who have, instead of W-2, they have 1099 type income. The next type of person would be, let's call it your local landlord who is basically using this as a rental property. Basically, you're going in, it's a non-owner occupied property that is underwritten based on the property's ability to generate cash flow through the rental income. So you're looking at it just as we would look at in the securitization, what is the cash flow that is being generated? I'm going to put a little bit more money down for this one. So this one has a 65% loan to value. And these are ones which it's not the highest portion of non-QM, but there's a large portion that are doing these for these non-owner occupied type properties. The next type would be somebody like, we'll say they had a little bump in the road. And people have bumps in the road. But unlike subprime, where you'd put no money down, these are people that are putting 35% down. And maybe their FICO score is a little bit lower, 710. But right now, they don't qualify for, we'll call it a prime jumbo, but they're going to put enough money down where they can basically purchase a home through a non-QM mortgage. The other person is a foreign national. And that's something that Freddie and Fannie mandate, that you have to be a U.S. citizen to go and borrow from a GSE. The last one would be, we'll call it your retired couple with a healthy investment portfolio and 401k, meaning you don't really have much income, but you have a lot of assets. And because you have those assets, they're going to look at those, they're going to value those, you got a good FICO score, maybe you're going to put a little bit less down in loan to value. But remember, these people are putting anywhere from 25 to 35% down. their financial commitment is quite great. They're not just going to get up and walk away.
So it seems as though these mortgages are significantly safer. And I mean, I always looked at it as these are the types of mortgages you always expected to be issued. So I guess, how does Hildene approach this asset class, and what are they looking for specifically? How do they not get into the old traps of what happened during a subprime crisis, and can this become a non-QM crisis?
Sure. So where it's different right now is, we'll call it then and now, right? Back in the no regulation times, we'll call it 2003 to 2007, they had things called liar loans. Basically, you didn't have to validate how much money you had. And now with non-QM, they're only using verified income. So you have to go out and you have to actually verify your income. So if you think about it and you look at the chart below there, you've got a subprime mortgage, smaller loan size, lower FICO, no money down, okay? What we're looking at is more commitment, higher FICO. So it's for the person that doesn't qualify. The best time to be investing in mortgages is right now, because you had the biggest problem in the mortgage space in the history of money. And now mortgages have gone from no regulation to highly regulated. And this has come with time. This has taken some time to do it, but now we're getting to the point where we're creating these mortgages, which are good pieces of paper, and these mortgages have to be sold somewhere. And that's what we're doing here. We're buying them and securitizing them. So some of the other things that are different is you have income verification, which we just talked about. And the other thing that we also have is property appraisals. So back in the golden age of no regulation, subprime mortgages were created with teaser rates and option arm rates. And they pushed borrowers into products or properties which were over their means. Now with non-QM, there's simpler loan structures offered to borrowers who qualify based on worst case payment shocks. So they're very simple, straightforward mortgages that are being created and sold to qualified buyers.
Very interesting. And in fact, I think that's one of the tenets that you always said. You always want to invest with somebody with skin in the game. And it appears as though these mortgages, unlike the subprime crisis where you're putting no money down, you have real skin in the game, or the investors have real skin in the game on these mortgages and don't walk away that easily.
That's exactly right. The one thing which I always remember is my father in 2010, he asked me, he goes, how did we get into this problem? My father was 85 years old at the time, and he was a retired merchant marine captain. I should have gone to sea like everybody else in my family. And I said to him, people are buying homes with no money down. And he was shocked. He goes, I don't understand. And he goes, when I went and bought 79 Hewlett Avenue, where I grew up, he goes, I put on my suit, put on my hat. This is showing you how old he was. Got all the information he had, all the money he had, put 25% down to buy this house. And it was the biggest investment he had. And he told me the happiest day he had was when he paid that mortgage off. But he was just shocked to hear that. And it was just that simplistic thing of how could we ever let that happen? And, we've regulated a lot of things. We're invested in two big assets here, banks and mortgages. And what was the driving force of the financial crisis? Banks and mortgages. What are the two most highly regulated asset or industries there are right now? Banks and mortgages. And we're not investing in the equity of these banks and mortgage companies. We're investing in the credit of them. And they're making sure that these banks aren't going to fail and that these mortgages aren't going to create another crisis.
But Brett, there still is, and there seems to always be a push by the government to make sure that people own houses. It's always been a people dream, own a house. And okay, we could say the subprime crisis was the perfect storm. How can we be certain, or how can we make sure our investments are not setting up for another perfect storm?
Well, I think when you have commitment, and real commitment, meaning capital down, I think that's the first driving force. I think the other one is the amount of regulation now in the mortgage space gives me a lot of comfort.
So Brett, you've said it before and you've said it numerous times during this podcast already. You only invest in spaces where you have a competitive advantage. Why do you feel Hildene has a competitive advantage in the non-QM space?
So when you think about our competitive advantage in non-QM, a lot of it is driven from our sourcing channels that we have. We've created a relationship with Cross-Country Mortgage.
And who is Cross-Country Mortgage?
Cross-Country Mortgage is, I like to say they're an old school mortgage broker. And when I say old school, I'm going to talk a little bit about it now. So with the change in the fintech and that space, a lot of people are focusing on being a wholesaler, meaning they go out, you go onto an app, you look, you say what you want, and they will go and sell that mortgage for you through some of their channels. Where Cross-Country is different, and that works, that strategy works well if you're just dealing with agency mortgages, because those agency mortgages are going to be sold. Where Cross-Country is different is that they are licensed in all 50 states. They have more than 900 retail locations, 2,200 loan officers. Meaning when you're going to go get a mortgage from Cross-Country, you're going to go in and sit with a human, and that human's going to walk you through the process. He's looking to, when I say he, Ron Leinhardt, who runs Cross-Country Mortgage, is looking to build that relationship. So you come back to him over and over and over. But what they wanted somebody who is going to be there to buy their non-QM pipeline. And what we've created is a systematic approach, and we're going to go out and talk to Justin. Justin's going to walk us through that. But it's a systematic approach where they can streamline the process, and their brokers, their agents, can go out with high confidence and tell someone where they can issue a non-QM mortgage. Let's go out and see Justin now.
Brett brought up a number of points and summarized the QM market, but he really never went into what is the life cycle of a non-QM mortgage?
Sure. We start with a home buyer looking for financing to purchase his home. In this case, let's use a doctor with a private practice as an example. The doctor's realtor refers him to his local CCM salesperson who chooses a loan program that best fits his situation. The borrower provides income documentation to CCM, but due to the nature of his business being a sole proprietorship, he's only able to prove his income using business bank statements rather than traditional W-2s. Since he doesn't qualify for an agency loan, we present him with a non-QM loan option.
So Justin, explain to me, because there's no defined offtake for this type of product, how does Cross-Country know what to charge the consumer for a mortgage like this?
That's dictated by our rate sheet, which is effectively a matrix we send out to the CCM sales force daily. It presents the price Hildene will pay for a given coupon with adjustments for different credit characteristics like FICO and debt-to-income ratio. The rate sheet allows the loan officer to offer a mortgage to the borrower with a defined loan amount and coupon, and also provides a high level of certainty that the loan's actually going to fund. It also provides certainty of sale to CCM, because at that point, Hildene is obligated to buy the loan upon closing. CCM then underwrites the borrower and the property, collecting all needed documentation. And if it meets our guidelines, it funds.
Thanks, Justin. So in this process, what happens next?
After performing due diligence, Hildene buys it into one of our non-mark-to-market warehouses used to aggregate for securitization. We then employ banks and rating agencies to structure and market our new issue securitizations, which are usually 350 to 450 million in size. We market the rated bonds to money managers and insurance companies, and then retain the bottom of the capital stack.
So this is all great and informative, but based on this, how has the relationship with Cross-Country played out to date?
It's working great. We've done over 9 deals and bought 7,000 loans representing roughly 3.7 billion of collateral balance. And at this point, we're buying about 400 million of new loans every month.
Thanks, Justin. I really appreciate it.
Thanks, Jason.
So Brett, looking ahead, where do you see the non-QM space going?
Well, it took a long time for the regulators to figure out what mortgages were going to be after 2008. So for a long time, getting any type of mortgage was difficult. But with the way the product is working now, I see this continued growth of this product. The American dream is to own a home. I don't think that's going away. I know all these millennials talk about renting and everything else. People want to own homes. Someone's got to own that home. And more people are self-employed and more people are doing it, but people are putting the money down to own a home. And that's the difference. So I see a continued growth in this asset class.
I know we're running out of time. Thanks for breaking this down. I'm really excited about this because I do believe you've made this a lot more accessible for people to understand what everybody else considers complex products. I know we don't, but it always has that stigma.
This has been real exciting. I'm really excited we had our first discussion, and I look forward to many more that's going to come out of this. Thank you. Hi, this is Brett Jefferson, President and founder of Hildene Capital. And today I want to talk to you about a very special organization, one that Hildene Capital supports. It's an organization called Team Impact. Team Impact has a very, very simple message. They take very sick young kids and they align them. They actually put them on college sports teams. And just so you understand, when you're a sick kid, you usually spend a lot of time in the hospital, you don't have a lot of friends, you don't go to birthday parties, you don't have a normal life. So for these kids, this first interaction with this team is the first time that they've actually been a part of something. And they take it one step further, where these kids have a signing day, they're on the roster, they're part of the team. But it really helps benefit 3 different people, which is very unique for an organization. One is, it benefits the young child that now is part of an organization. Next is, it really benefits the parents, because for once, they get to meet other parents. They get to see their child happy. They get to see their child part of something. And the third is, the student athletes. They get to see exactly what this child is going through. And maybe some days when they're having a tough day, they can look at this young child and say, my day's really not that bad. So, Hildene, we're supporting Team Impact. And I encourage you to go to their website, look about what they do. And if you feel it in your heart to make a donation, please put the word Hildene in your donation, because we're going to match every donation that comes in up to $100,000 to help support this great cause. Thank you.